Okay, so it's a little bit after 2. I know we've got a lot of material we want to cover today, so let's go ahead and get started. My name is Allison Pepper. I'm the EVP of Government Relations here at the 4As, and I want to thank our guest speakers for joining us today for the second in a series of topics that we've been doing on cybersecurity. So for those of us online who were able to join us for the first webinar in the session, did a little bit more of the technical overview of some of the issues that we're seeing in the space right now. But I want to bring our folks experts here today to have a little bit more of an in-depth discussion about some of the other things we're seeing, particularly in the cybersecurity insurance market. I know it's a concern for a lot of our members who have really been paying more attention to the space over the last few years. So with that in mind, I'm very happy to welcome our 3 expert speakers today, Daniel and Andrew from Access, and Barry from our benefits department in North Carolina, whom I'm sure a lot of you already know. So we're going to cover a lot of the cybersecurity insurance topic today, and I will not even pretend to be an expert on this. So I'm glad that we have these folks here to do it. But before we get into sort of the heart of it from our partners at Access, I'd like to ask my colleague Barry to give us a really kind of a brief overview and an intro into sort of the overarching topic of why agencies need cybersecurity at all and cybersecurity insurance, and why we're starting to see more demand in the space. So with that, Barry?
Thank you. The single biggest question that most agencies will ask is, why do I even need cyber insurance? And a couple of the big points are cybercrime is a very opportunistic. No longer is an agency too small or too little to be affected. It affects everybody from a one-person agency all the way up to the very largest. The other big point is very often it's a minimum requirement now by your clients, large or small, to protect their interests. So very often this is something that's required when going through contracts. Then the other issue is the financial risk is now large enough that could end the business. The financial burden impacts very small agencies or very large agencies. So the other issue is that most people will then say, well, I have business interruption insurance. Does that not provide coverage? Well, this is very often referred to as what they might refer to as silent cyber coverage, in which that your normal policies such as property, casualty, or crime could cover a cyber instance, but that was never really truly the intention because it wasn't excluded in the policy. So with the change of and the rise of cyber, you're seeing now many of these insurance companies are listing cyber as a named exclusion. So it's not being covered under normal business interruption. But if it is covered under business interruption, there is some key differences. And one of the main differences is the period of measurement, which is how long before the coverage kicks in place, where cyber insurance can come into effect within hours of an incident. Business interruption insurance might have a waiting period of several days before the coverage could begin. The other big issue is, what is the period of restoration? Normal business interruption insurance is to get you back up on your feet and get your business restored, not to fully restore every issue such as your computers, your data, any other system that might be impacted. Another big concern is geographic limitations. Very often regular business interruption insurance is limited to a single office or a single location, whereas a cyber event, that doesn't really matter because it affects possibly multiple locations in your employees at multiple offices. And then the last big thing is the reputational risk. Business interruption insurance is to get you back up on your feet. It's not necessarily to cover the cost or the impact to your clients. And then there's some key issues that could certainly fall outside that, which would be indemnification for legal fees and expenses, customer notifications in the event of a breach, which would fall outside the business interruption insurance. The option to monitor information for anyone that was impacted for the defined period. Costs that you may incur for recovery of compromised data, cost to repair of computer systems, and cost for cyber extortion, which obviously has become a big issue now too. So those are all items that a normal business interruption policy might not be able to cover, whereas a defined cyber coverage is made to address these issues. So I'll turn that over to Daniel and Andrew to go into further detail.
Sure, that sounds good. Thank you, Barry. And thank you everyone for joining us to talk about cybersecurity. It is a topic I get excited about, but I certainly understand that it's not everybody. So I'm hoping to make this as educational and entertaining as well. I am Daniel Gibson, and I'm a cyber risk advisor at Axis. And I'm joined by my colleague from the UK, Andy Marr. He is the Deputy Chief Underwriting Officer for Global Cyber and Technology. And taking just a brief look at the agenda, Andy will cover the first couple of bullet points there. So discussion of what's driving the increase that we've seen over the last several months, and an understanding and overview of coverage, trends, and sort of all things insurance related to cybersecurity. And then we'll take a brief look at how underwriters make the decisions when they receive that application for either new business or potential renewals. And we'll go into a little bit deeper of 5 critical controls. I know many of them were discussed on the previous webinar, and we'll take just a little bit deeper look at those. Have a word on questionnaires and audits. I'm certain you've run across those. And then we'll conclude with some recommendations and guidance and some additional information. So we may not go into the additional information very deeply, but I did want to just give you some resources to hopefully be assistive as we cover those topics and as you experience those in your organizations. But for now, I'd like to turn it over to my colleague, Andy, and we can discuss what's driving some of the increase that we've seen and an overview of that trend, those trends, coverage, and other topics there.
Thank you, Daniel. Hi, everyone. As Daniel mentioned, I'm Andy Marr, Deputy Chief Underwriting Officer for Global Cyber and Technology at Axis. I've been on the cyber underwriting side of life since late 2010, so I've seen a little bit of change over that time and over my career so far. Just to kind of get us going, want to take you back in time a little bit to kind of the beginning of my career and really what we were selling as a cyber policy. Cybersecurity really took off really in response to some of the breach notification laws that were out there. Predominantly was California Medical Information Act, so breach of medical information of California residents. Really, there were statutory damages or still are statutory damages that come with that. So products were being put together to respond to the breach of that information and pay for any damages that might arise. Those kind of notification laws, as I'm sure you're all well aware of them, sped up and started popping up everywhere, including, HIPAA, the Federal Health Information Act, governing, response and ownership of a data breach and how an entity must respond if public health information or personal health information has been breached. As well as, actually back in 2010, 46 of the 50 states had their own breach notification laws. Now all do have their own breach notification laws, and they are inconsistent. So even if you have a data breach, you can't just respond in any one way. Even if it's the federal healthcare law, HIPAA, if you comply with HIPAA breach notification laws, you don't comply with FIPA, the Florida Information Protection Act. So they do get very complex. So a lot of what we were selling in the early days was an insurance product to help companies respond to a data breach and navigate the complex notification landscape and regulatory landscape out the back of that as well. The reason I kind of said cyber policies in inverted commas is because there wasn't actually much cyber. If you think of cyber, you kind of think of that hacking, that expertise, someone really getting into systems and being quite technical. Most of the losses we had back then were actually really lost unencrypted laptops, unencrypted backup tapes, and it was really all in the kind of healthcare and education space. So a lot of universities, still a lot of schools, and in particular hospitals. So as cyber got, cyber insurance was being sold more and more. The financial institutions started buying it, and importantly, retailers started buying it because of the credit card information they were purchasing and having to comply with PCI DSS, payment card industry data security standards. And I'm sure you're all very well aware of what was going on in 2013 with the likes of Target and Home Depot and the data breaches that happened there. Well, at this point in time, there wasn't much business interruption coverage in cyber policies. They said it was mainly kind of breach response, costs to cover, sending out notification letters, alerting affected individuals, paying for identity or credit monitoring if their information was affected. There wasn't really business interruption coverage. So then the retailers all started having their big data breaches predominantly at the hands of black POS malware, POS being POS, payment systems. And I'm sure you all, or a lot of you, got new credit cards once, twice, maybe thrice, when the likes of Target, Home Depot, and Jimmy John's had their events. At the same time this was going on, cyber was only really being sold in America. We had started trying to sell it predominantly in Europe on the continent. The difficulty was that there wasn't any breach notification laws yet. GDPR was still a kind of pie in the sky, and so a lot of companies said, "Well, we don't really care. If we don't have a legal obligation to alert customers, then why would we?" We said, "Well, we will still pay for you to alert them because it's good PR." And I said, "Well, why am I going to buy a policy for you to do that if I don't have to?" So we actually started looking at different ways to sell to European companies and other countries and other territories that didn't have breach notification laws. What that led to was development of business interruption coverage within cyber. Now, in the US, we did have that coverage available, but it wasn't standard. So we were charging 2.5% to 5% additional premium to add cyber extortion as a coverage. We were at and also then kind of 12.5% or 15% additional premium for business interruption. But business interruption being security breach trigger only, i.e. a malicious trigger. Someone had actually hacked into your system and taken it down. And we're only doing that for your system, not for your cloud provider that might be hacked and which then impacts you. It was only for your systems. So at this time, Target and the other retailers have suffered their incidents. And they've really buttoned themselves back up, predominantly because of the work by EMV, which is chip and pin, but it was Europay, MasterCard, and Visa that banded together the liability shift that came with that and enforced chip and pin by the 1st of October 2015. So when the retailers all started, renewing their policies, they really didn't have much privacy exposure anymore because credit cards weren't being held on their systems. They were using end-to-end encryption and tokenization in particular. Tokenization being a tool that means the main credit card data is actually sitting with the payment processor and not with the retailer themselves. So the brokers were kind of looking around and looking at underwriters and saying, well, surely our premium should be going down because there's a lot less exposure for the coverage that's being provided. This led to business interruption coverage broadening out in the US, firstly within the retail space, but it's insurance and it doesn't take long for that, especially with a product like cyber, something that is growing so quickly and was profitable apart from in the retail sector and 6 months later in the healthcare sector. There was a lot of competition coming in. People wanted to get a foothold within the cyber market. So the business interruption coverage broadened out very quickly, leading to non-malicious triggers becoming quite standard. So system failure, we call it. So your system going down for any reason other than a natural peril or actually the internet going down, infrastructure as well. So this got us to a point where to be in the cyber market, you had to provide this non-malicious coverage as well. So we have the malicious, the non-malicious, and we're also extending now to the cloud providers, your dependent service providers, any kind of IT providers that you depend on to conduct your business. So we're at quite a broad spectrum now, and a lot of other companies and industry sectors are buying. It's media agencies, it's oh God, what blanking on industry sectors is manufacturers, right? Especially manufacturers. We've been trying to sell privacy policy to manufacturers for so long. Business interruption makes sense now. It's you know, the automotive industry is buying now. Everyone is starting to buy cyber insurance. In the back end, down in the dark web, we have the criminals working on some new products and some new services. RAS being the main one, ransomware as a service. Essentially, as criminals sitting there with a platform and say, bring us a list of email addresses, we'll launch some ransomware, some phishing emails, we'll launch phishing email attacks out, and we'll take 10% of the profits. So we'll send a phishing email to, say, your 1,000 email addresses that you've collected, whether they've bought that list on the dark web or just collected themselves. And they'll send out a phishing email, and they might get, you know, a 1% or a 2% click rate, demanding 1 Bitcoin. Now, back 2013, 2015, really, a Bitcoin was worth a lot less than it is today. We really started to see that expansion of ransomware and really started to grow at that point in time. What we had been seeing before was actually more large events. So kind of we had the severity side. And as ransomware as a service became more prolific and a lot more companies in the underground started offering these services, we started to see the frequency. You know, the issue with insurance is we can handle severity or frequency. It becomes an issue when we get both at the same time. But the frequency was really coming from the low-hanging fruit, i.e. companies that weren't training their employees, so employees are clicking on the phishing links. Companies that aren't securing external remote desktop protocol, allowing easy access into the network from threat actors, as well as not having multi-factor authentication in place for remote access. So the problem was, at the time in the cyber market, it was becoming so competitive because it had been so profitable, bar those two industry sectors of retail and healthcare, that it had kind of become a race to the bottom. Who can write the most business while asking the least amount of questions? And then we're in kind of 2020 at this point. We're in 2019, 2020. A lot of ransomware is starting to hit the market. And it's not industry specific. Yes, there were certain industries that got hit harder. Healthcare in particular got hit harder, but we're starting to see it across all industry sectors, and not just ransomware, other types of malware as well. You might be aware of the HBO attack by the Dark Overlord, leaking Orange is the New Black and leaking Game of Thrones. We're also seeing it at the universities. We're seeing it at you know, the city of Atlanta. It's gone widespread. So it was kind of, you know, where is this? What is the trend? And we're playing whack-a-mole a little bit. To the point we then realize, you know, this isn't actually an industry by industry sector or a size by size. This isn't just the SMEs, the mid-market, or the large risk. This is purely down to controls. And because we have the frequency and severity, what we need to do is twofold, maybe even threefold. We need to look at retention levels from a kind of insurance perspective, whether, you know, if it's 50 grand, it needs to go up to 100 grand and even more. The average extortion demand was getting higher and higher as criminals realized, especially that a lot of companies bought cyber insurance. And in some cases, were finding those cyber insurance policies on their network and using that as an extortion demand. We know you have $10 million of cyber insurance. Please pay. We had to look at it from that perspective. We had to increase increase the prices to, you know, not only recoup from the losses that we were seeing in the market, but we were also learning that actually cyber insurance was far too cheap and it should never be that cheap. Which is why what we're seeing now, the increase, it's hopefully we're not going to the market start coming down too much, because nearly every single cyber insurer was affected by ransomware. There are new ones coming in now, but most of them have underwriters there who have experienced and so shouldn't be driving down prices. But most importantly, we needed to look at controls. We needed to get rid of the low-hanging fruit, the companies that weren't doing the basics, not backing up their systems, not putting MFA in place for remote access or securing their remote access, not securing the remote desktop protocol. That's just the low-hanging fruit. And then we go into a lot more. We wanted to see more mature clients in terms of, that they've locked down how people might get inside, but then how might people move around if they do get inside? And it's very difficult to secure your system 100%, which you can secure at 99%, but there's that 1% chance. And that's what insurance is. Insurance is at 1%, right? It's not there to be a piggy bank, which is kind of what cyber insurers have become. A lot of companies were buying cyber insurance to say, actually, we don't need to invest in cybersecurity. We can just buy a cyber insurance policy. That's where this market made its mistake. And remember, we are in our infancy as a market, well, adolescence, shall we say. So that's really where the market got to. Coverage has started to pull back a little bit in terms of the business interruption, the breadth of business interruption. It's not for everyone now. We had airlines with very broad business interruption coverage with non-malicious triggers, just system failure. And the market paid claims on those as well. Southwest Airlines, for example, had a very public one. So this market has had to learn a lot and mature a lot very, very quickly. And just on this slide here, and I've just been talking away, some of the other coverages that are available and have been available for some time in the market, reputational harm, for example, being one. So that is saying, if your sales 12 months after your event have dipped or dropped off due to the cyber attack, then there is coverage for that. It's not a coverage that has been claimed under very often. Target, for example, their share price was up 12 months after their event, but it is coverage there, and it does provide some comfort for you. E-theft as well is normally a very, very small sublimit, but that is that kind of fraudulent instruction. That is someone spoofing and pretending to be your chief financial officer and asking you to transfer money. Daniel, can we go to the next slide, please? You're on mute. Sorry.
We can. This is the next slide is about the underwriting decisions. So I'm happy to take that, or if you would like to take that as well.
We can. I'll talk a little bit to that. So from
Sure.
and kind of did just touch on a little bit at the moment. What we're seeing from an industry perspective really is companies that have invested money into their cybersecurity maturity. And the issue is there are some industry sectors in particular that do not have the money to invest in their cybersecurity maturity. Education sector being one in particular, and the public entity, state, government, and industry sector. Now that, and you say, well, we're not in those sectors. So why does this affect us? Because we all have portfolios, and sadly, the losses of the few get paid for by the many. So I'm just reading through this. Just want to see what I need to touch on. What ransomware also did in the market, some markets came out and were putting co-insurance into place. So if you have a ransomware event, where the insurer will only pay 50% of the loss, you are on for the other 50% of the loss. Some carriers started sublimiting extortion, sublimiting ransomware. So you might only have a 10% sublimit for those coverages. At Axis, we didn't feel like that was the way to go. For us, it's, well, if you feel like a company might have a loss, so you're going to give them less cover, then surely their controls aren't up to scratch. We took the approach of we don't want 10% of it, we don't want any of it. So we took quite a hard stance we wanted to provide coverage to those companies that had been working on this cybersecurity maturity and meaningful coverage. We didn't want to have to dilute our coverage because we were still working with companies that weren't up to a security maturity level that we felt was necessary and kind of a minimum baseline. We kind of coined the term seatbelt moment. This, in the automotive insurance world, at one point it was you will not be insured unless you have seatbelts, and that was that for us. Certain controls that Daniel's going to talk through that you have to have in place to get insurance from Axis. You get full coverage. It's not diluted in any way. It was a hard decision to make. We had to walk away from a lot of clients, but we're still here. We're in a good place and providing full, meaningful coverage. Daniel, over to you, my friend.
All right, excellent. And Ron, I do see that we have a question there. I do want to be sensitive to both time and to your question as well. What I'll do is ask if we can take that one offline, and I can share that with Andy, and we can get back to you on that particular one. Another sensitivity is it is quite late in the UK at this point, but I did want to address that, and I'm not ignoring that. We can definitely take that offline and get back to you. All right. Excellent.
Thank you.
Thank you very much. All right.
Any questions, and Daniel will filter through to me, as I do need to drop off now. Thank you for the opportunity. Have a good day.
Yeah. Excellent. Thanks all. Very good. We will move forward with the 5 critical controls. So these controls are sort of the baseline, and we'll begin with MFA. Just wanted to start with exactly what MFA is. So we know that it's 2 or more verification factors. Normally the first one that we see is something that you know. So this is obviously knowledge-based, and it's a PIN, a password, or something similar. And one of the things that it is not, oftentimes some individuals get confused, is they'll say, well, yeah, I have a username and I know that username. And that is actually not an appropriate element, because these are very standard syntax. So first name, last name, first initial, last name, that sort of thing is assigned, and it's not very difficult usually to understand what that is. So first, something that you know. The next one is something that you have. So this is this is something in possession of you, and that's what that little hand there means. This is a badge or a smartphone. Where is the delivery mechanism there? Or it could be a physical key, a UB key, or a token, something like that. Then the next one is something that you are. So these are the biometrics, the fingerprints, the voice prints, the retinal scans, etc. And finally, we don't see this one very often, but it often runs in the background of many solutions. So this is a location-based, somewhere you are. And I just wanted to make a brief clarification. We'll often see 2FA or MFA used interchangeably. They're very, very similar. It's just a subtle difference. So 2FA means 2 of those factors. MFA, multi-factor, means 2 or more of those factors. And you can layer these on for additional security if you would like. So that's just the definition portion of it. Now let's take a look at some of the specifics. So in this case, security questions. Unfortunately, you still do see these being used many times, even at banks, financial institutions, healthcare institutions. These are not really an adequate means of MFA, simply because of one thing, and it's consistent through the remainder of these as well, and that's the human element. Oftentimes, there's not necessarily a weakness with the technology, the delivery mechanism, etc., but there's a human element that can be exploited, and this is one of the easiest to exploit. We often use things that we're familiar with, and we post them, and we're public about them. Or conversely, when it says, who is your favorite teacher in the first grade? I have no idea. I'm likely not going to choose that question. I'm going to choose the ones that are top of mind for me. And I'm likely going to post about it or be open about it. So these can actually be guessed rather easily. I didn't include it, but a Google search will show how easy it is. A coffee company or a anti-fraud firm simply said, hey, if you like us on Facebook, we'll give you a free coffee and a free Danish. When they did that, They had access to the Facebook, and then they were able to identify a lot of specific information, which they then wrote on the coffee cup and said, here you go. And that was an example of how easy it is to compromise particular information. The next one we'll talk about are device certificates. So these are small encrypted certificates or small little things that go on a computer. And normally they are very, very good. The encryption that they're utilizing is very strong. The challenge that I have with these are it identifies only the system that is logging on, and it is not necessarily identifying the individual. And the other part, the underlying part, is how are these managed? Oftentimes, technology security folks, they're doing multiple things, and this is just one of their responsibilities. And we've seen instances where initially they said, well, no, these certificates cannot be copied onto a new machine, when in fact they can, and they have been, or they're not managed correctly, they're expiring, or someone terminates, but the certificate is not expired with them. So the underlying management of these can be problematic and not necessarily the certificate themselves. I absolutely love these as a secondary factor, because if you have, say, another instance of MFA, such as these, or an authenticator application, in addition to a hardware or device certificate, then you have that extra layer of understanding who is logging in and on what device they're logging in. And if both are approved, that's much more secure. The next one are the SMS and text messages or emails. These are challenging because there's very little authentication, and we've seen these. Hey, this is your bank. You know, we found some suspicious activity. We're looking to protect you. Call us at this number and we'll help you. Well, in reality, that's a threat actor. They've already hit your bank, and they're logging in, and they're saying, okay, go ahead and log in. Okay, we're going to send you a PIN, which is the PIN from the bank, the request. You get that from the bank, and then they'll go ahead and just say, okay, here it is. Yes, that matches. That's good. That is exactly what we're looking for. And now, of course, they're in. Additionally, all of the other scams that are very prevalent with SMS and texts. Again, these are not the most secure. Another reason why is because it's not difficult to swap out, to do what's called a SIM swapping. So that is when a threat actor does enough research on you as an individual to call the customer service line at a provider, a telecom, impersonate you and answer all the questions accurately to identify you and say, I just need to change my service over to this new device, which is, of course, the threat actor device. And because they've done enough research and they know the last four of your social security number, your address, or whatever it is that they are asking, they can then turn that, move that service to their phone. And the user, the end user, you, may not even be aware of that for some time. All you may know is that your phone went silent. So, and there are just, SMS and email is generally just a much less secure option. Nevertheless, it is incredibly easy to implement for organizations. So we still see this quite a bit. Authenticator apps you're likely familiar with. The biggest challenge that I have with these are the MFA fatigue that I believe Patricia mentioned. And that was what happened recently with Uber and some other organizations. If someone continuously tries and you're getting pinged all the time on your phone 100 times a day, you may just say, forget it, I'm going to say yes just to get rid of this. And of course, you've just let someone in. But these are generally fairly safe as long as you have that education about potential MFA fatigue. Moving into the very safe are hardware tokens or smart cards. The challenge with these is you have to have, these are the possessions, so something that you have, and you have to maintain these with you at all times. Once you lose possession of it, then you're not 100% sure if that has been compromised, used, etc. So it becomes a challenge. And then finally, the biometrics. These are, the beauty of these is that they are very specific to you, cannot be changed. The challenge is that these are very specific to you and they cannot be changed. So in the event that there's a compromise, You're not going to be able to change, your palm or your face, your face, etc. So it could potentially be used down the line. These are still some of the most secure, and really that's because if you're in a bank and you're doing facial recognition, or if you're using your phone for initial facial recognition, and then once that's approved, then the token goes to the other third party and they let you in. It could potentially be more challenging for an organization, or a criminal organization, to duplicate that. And certainly when you're on premises at a bank, etc., it would be difficult to do that. Even so, like I said, these have all been defeated. And this is important. Whoops, my apologies. This is important because threat actors are looking for the most access possible. Administrative access is the goal. They have full ability once they have that. So take the time to inventory and document that inventory of users, administrative users, even elevated access users. Protect that information, monitor administrative access, and continue to do training and awareness, especially with some of the specific details with the application, authentication applications. Ensure that your end users are not falling victim to that particular fatigue. One of the things I also wanted to mention about MFA or any of these controls is that a threat actor is not necessarily, they're looking for the easiest target possible. And even though these are the most critical controls to have in place, and we're looking to make it more difficult for a threat actor to compromise your organization. They're looking for the most juice for the easiest squeeze. So if you are able to increase the effort that they need to apply toward compromising your organization, they may just go elsewhere. And that's why we're talking about these. So endpoint detection and response. It's also several different acronyms: EDTR, MDR, network detection and response, XDR, etc. These are sort of the next generation of antivirus, anti-malware, but they take it a step further. Some of examples of these: CrowdStrike, SentinelOne, these are sort of the top of the list. There are others as well that are also very good. And one of the reasons that we like to see this in the insurance industry is that legacy signature-based is insufficient. Just as we are making progress with antivirus, the threat actors and the criminal organizations are doing their best to overcome those. And they had, from a signature-based, effectively a look back to say, well, this is what we've seen in the wild, so now we know how to protect this. But it didn't protect us from anything moving forward or anything that we hadn't seen before. So now these solutions are able to do that. Not necessarily something that we haven't, they may not be, they can protect you from something potentially new that they haven't seen before, based on the AI that they're using and leveraging. And it's important because prevention alone can't ensure protection. It's not that hard outer shell anymore. So if they can get past that, then they would potentially have the ability to do anything within the organization undetected. So if they can get past and now they start to do something, these solutions can identify that and then do a quick response, whether it's an automated response based on the application or the software that can quarantine a system or quarantine multiple systems and then report back, etc. And that's what that fourth bullet point: organizations potentially lacking the visibility needed to effectively monitor endpoints. So it's not just a set it and forget it type of thing. If there is something that's detected, you need the personnel and the resources to be able to identify it, investigate it, and then potentially take action. And that's what a lot of these services do. It's not just the tool, but it's the response that you're potentially paying for. And then having that data, again, that's just part of the solution. What are we going to do with that data? And what intelligence is around that? What decisions are we going to make? Has it impacted, X systems and it hasn't yet been detected? And are we going to turn those off? Are we going to shut portions of the network down? Or potentially, how are we going to respond in a more aggressive manner to protect? Or are we confident that this is only potentially an isolated incident? And the one thing here I wanted to mention, just that last point, is EDR is not a security operations center. For many organizations that I've come across, they say, well, we don't have a SOC, we have EDR or MDR, or absolutely, we have a SOC, it's our MDR. And that's not the case. They're certainly getting closer to that with network response, detection and response, managed detection response, XDR. But it's not right now, it's not yet a unified type of response. As I said, they're evolving, they're getting better, and it wouldn't surprise me in a couple of years that many of these sort of come together and they make multiple offerings so that indeed they are sort of covering the entire network for these types of malicious intrusions. All right. A word on backups, testing, and recovery. So what we like to encourage organizations to have is a 3-2-1. So have at least 3 copies of your data. 2 of those should be stored at separate locations. So if something happens physically to one building, you still have a backup somewhere else that is not impacted. And then at least 1 in an offsite location, whether that be the cloud, whether it be a separate data center, etc. We often see organizations that maintain something on site for quick file and folder restoration. That is fine for that. Still have MFA in front of that because it is still a rich source of information for threat actors. So we want to protect that. And then also have it off-site and potentially offline as well. Just a word on some of these. Immutability, very good. If you can get that, if that's an offering that one of the vendors utilizes, we like to see that. That's great. Offline is, I see multiple interpretations of this. And offline means that not able to be directly accessed from your network. So if you have a cloud-based, or if you have a separate third party that may have a device on your network, or they may have a separate one in the cloud, it's offline. So you have to either use a separate username and password to access it along with MFA, but no one can get there directly simply by navigating to the application, the backup application, that automatically connects to those data sources. Offsite, that one's pretty easy. The further, the better. That's why the cloud makes it so attractive, because you can have multiple off-site replicas or replication to various regional data centers. And of course, air-gapped. When we say air-gapped, the traditional idea is, yes, you have a gap of air so that no one can gain access. In this case, that's the best. If you can do that with tapes or with disks, that's fantastic. But that offlineness as well, having a separate username and password to log into, along with MFA, to log into a separate environment, that is also good. And now I just wanted to take a quick moment to talk about these 2 points. So RPO and RTO. So RTO is the amount of time it's going to take to recover. Obviously, with really great backups, that's shrunk. And the RTO is, sorry, the RPO is the point. That's how far back in time your backups are good for. And the RTO is how long it's going to take you to restore to that point. Understand these. And we know, certainly for smaller organizations and businesses, it's a little bit of a challenge to understand what these are. But ask your business folks, people who are on the ground, how long could you limp along without this particular application? And they're going to say, well, we've got about 2 hours before things start to fall down. Well, you know that your recovery time objective now is a 2-hour time objective or less. And hopefully you want to have it as quickly in the past as you can. So previous day, so you're not losing more than 1 day. Hopefully it's not a week or a month. But understand what those are, and I'm sure you've run across those in the questionnaires. And it's good to simply understand what they are and think about them so that you can give as close an estimate as you can. All right, vulnerability scanning and patching, another one, a critical one. So first we have to understand our assets. What do we have? You can't manage it if you don't know you have it, and you can't patch it and secure it if you don't know that you have it. And then once you have the asset inventory, you do some scanning and vulnerability assessment, and then you take a look at what you've got. And it's not just the criticality ranking that the CVSS score provides. This is a very high or critical. That's a big part of it, but also take into account where it exists on your network. Do you have that service that's impacted actually installed and running on your network? It may be a high over here, but if you don't have it installed or running, then it's for your organization, it's a much smaller risk. Understand what that is and have an active process for that. So we already talked about inventory and discovery. The percentage of your environment scanned. Normally insurance companies are looking for a very high percentage, 100%, at least 95% scanned. Some we understand systems may be offline if they're laptops. They may be offline. So achieving 100% can be a challenge. But it's always good to say we aim for 100% and we have it, but we do have just operational challenges. Someone's out of the country, they turned off their laptop. Someone, shut down their system overnight and it's going to come back on. But if you can say that, yes, 95 to 100% is scanned, except for those small exceptions, you'll be in much better shape. The cadence of scanning. So normally we like to see, ideally, if you're a large organization, a weekly scan or a continuous scan is best. If you're a smaller organization, at least a monthly scan is appropriate. And that's mainly driven by the number of vulnerabilities that are identified in any given time frame. So if you can do weekly scanning, would be wonderful. Monthly is appropriate. If you have to push it to quarterly, that's probably a little too not sufficient, because there's too long a window of potentially unknown and unpatched vulnerabilities that could be exploited by a threat actor. And then finally, not quite finally, the internal and external scanning. External scanning is going to be critical for your externally facing infrastructure. So if that's websites, if it's VPN, if it's wireless access points, we want to be sure that there are no unknown vulnerabilities. And then internal scanning is if someone were to get in or be in your organization, what vulnerabilities would they potentially be able to exploit? And that's often the critical part. Remember, we talked about the perimeter and getting in and then having free access. Well, if they can get in and there's now multiple areas or devices that can be exploited because those vulnerabilities are not yet patched, that's just making their job easier. And we want to do as much as we can to frustrate that process. Penetration testing, and this is a little bit different. I want to make a distinction between vulnerability scans and penetration testing. So scanning is normally automated. It takes minutes to days. It should happen very often. It's passive. You can get a lot of false positives here, and it's very general. There's no exploitation involved once those vulnerabilities are identified. Penetration tests, on the other hand, is very different. That is generally manual. So there is a human or a group of humans sitting at a keyboard identifying certain things, and they're going to try to exploit within those rules of engagement, potentially exploit and see what access they can get. Normally, because it's so invasive, this happens 1 to 2 times per year. Much larger organizations can employ, I believe, as John had mentioned in the previous webinar, they have blue teams and red teams, etc. But if you're relying on a third party, normally do it at least once a year, unless there are major changes to your environment, and then that may elicit more frequency of that penetration test to ensure that the changes that you made did not enable any vulnerabilities or additional weaknesses there. The critical thing about a penetration test is it rules out the false positives because of that person actively trying to exploit that. It's very specific. Sometimes it's down to 4 or 5 IP addresses or devices only, and that's all. And again, we talked about the active exploitation. But these two things do work together. One is much more simple and automated, should happen quite often, and the other is much more manual, specific, and it doesn't necessarily have to happen at quite as often. And the other thing is really just to have this as a documented program. It's good if you have the practice of this, but if you have it documented to say, here's our vulnerability scanning, we're going to do it at this cadence, our patching windows are between here and here, that is going to provide comfort to an insurance company or a client or a regulator to say, yes, they have their act together. They actually have a solid, well thought out security program. So I wanted to mention just a few words on audits and questionnaires. The whole idea is to assess and ensure the security program is right for the organization. And this is something that I stress to anyone who is responding to these. An organization should not be looking for a small organization to have all the massive controls of an international financial services company. It just doesn't make sense. So make sure that your security program is reasonable for your organization and that it's right-sized. So we take, in the insurance industry, we take a look at organizations from sort of their revenue perspective, and we associate appropriate controls with that. So if you are less than $10 million, you should have some type of administrative access control. That can be separate accounts for administrative access, MFA, likely a vault of some sort of password vault. We're not looking for a CyberArk or a Thycotic or a Delinea, which is potentially simply out of reach financially for an organization. And you may have 2 admins, so it's not necessary to do that. Whereas that larger company, they could have 50 admins along with 150 outsourced help desk folks, along with others who may need that. So we want to control all of those. They're looking for that solid, thought out, consistent security program and plan. If you haven't heard of these, so SIG, SIG-Lite, a CAKE, a HECVAT, there are many standard questionnaires that exist that you may be able to complete depending upon your organization and the services and how you offer those services. And they may, and I stress may, accept those. Those are standardized questionnaires. Now the SIG is not easy. The SIG is over 1,000 questions, maybe not appropriate for a smaller to medium-sized organization. A SIG-Lite, absolutely. A CAKE is a cloud-specific questionnaire, and a HECVAT is also cloud. That's geared more toward higher education. That's actually what it means, but it is cloud-based. So some questions may not apply, and others may. The other thing is to know that many organizations follow their own process. It may be outsourced, they have automated scoring in place, and they do this because it's a consistent assessment across their entire vendor population. So they're trying to make it as efficient as they can for themselves, and that's why they're insisting on completing their questionnaire. The challenge is that it doesn't make it easy for you. The other thing I would say is if you do it once, keep it, go back to it as you're making changes and updates, respond, keep a current version of that questionnaire and update the response. So if you're tracking what weaknesses that have potentially been identified, and then you have a security roadmap to address those, keep track of those changes because that's going to make your life a lot easier. And then normally organizations have a risk-based approach. So depending upon the type of data you have, the number of services you're offering to them, how critical those services are, you may be ranked as an organization as a high, medium, or low risk. High risk organizations are usually assessed once a year, maybe more. Low are much less than that. It's either every other or every third, etc. But that can depend, that that risk identification can impact the cadence that you're assessed on. And finally, how you're responding. Simplicity is your friend. They're asking a very specific question, just answer that question. Don't embellish anything, but don't fudge anything. You know, if I'll use the example of the SOC with the EDR. If you have an EDR, don't call that a SOC, even though some of the services may appear to be. That's not the case. If you have MFA, say you have it and where you have it. If you don't have it in all those locations, say you have remote access and you have Office 365 MFA in place for that, but there is an option for users to enroll themselves and that option is still available, then don't say all. That has actually gotten some organizations in trouble. Be sure that you review it for accuracy. Ensure that someone who is completing that is providing the correct answers, up-to-date answers. Could be as quickly as last week, something was updated. Be sure that it's accurate. And then, you know, we always say that, you know, nothing stays the same and it is a team sport. Technology changes, business changes, organizations change, people will move in and out of that organization. So always show a willingness to plan and evolve. Take them seriously. The way that I always looked at questionnaires, as challenging as they were, is it's free advice. That advice may not always be able to be acted on, but we keep track of it. And if we say, okay, 3 critical clients are saying this one thing, so if we do one thing, we can address, you know, 3 clients, then we're going to begin to prioritize those types of activities and resources. I know we're running a little short on time, so I do want to address these. It's critical for any organization, especially a larger one that is assessing your security, to feel comfortable that you have a formal program, that you're following a industry recognized standard. So if you haven't already, it's best to align with a particular standard. In this case, this is the Center for Internet Security and their controls list. So there are 18 here, and they have sort of sub-controls beneath each one. Consider these the family of controls, and then you have sub-controls. They are free and available. It's a not-for-profit, the Center for Internet Security, and that's the link right there. Some other ones are similar, but maybe a bit larger. The NIST Cybersecurity Framework, or CSF, consider these the families. In this case, they reduce it to identify, protect, detect, respond, and recover. And here is what they're looking for under each one. If you were to download this, it's free. Here's the identify. These are the families. And all together, there are about 109 controls here for all of these families. Now, aligning with a framework doesn't necessarily mean you are doing everything, all 109 controls or whatever. It means that you're aligning. Some may not be feasible for a smaller organization. But if you can state, yes, this is the framework that we align to, that informs our security program, they feel better about saying, yes, they're applying to a specific standard, and it's not just the idea of their security person on what we should do or shouldn't do. The other ones were mentioned in the previous webinar, and that is NIST 800-171. Similarly, they're identify, protect, detect, respond, and recover. These are about 114 to 117 individual controls. This one, take a look at them and see which might work for your organization. This is the ISO 27001 standard. It generally tends to be a fairly significant uplift, but I believe, as Patricia mentioned in the previous webinar, you can craft it so that if you want to get certified, you are able to. But again, aligning with a particular framework doesn't mean that you're meeting all of those requirements. These are some recommendations. We have a cyber readiness panel, and this is the website. Simply clicking on that read on section will get you to multiple, and I'm going to show them a little bit later, but multiple resources for various functions. And I'm going to show those in just a moment. I did want to give you some additional resources. So as you can see, this is the FTC, Stay Safe Online, NIST. These are all additional resources that are specific for small and medium-sized businesses. So if you haven't heard of this, these websites, I highly recommend that you go. It's free consulting effectively from these organizations. And then finally, I'm not going to read through, but there's a list of panel vendors. So incident coordinators, forensic and ransomware services, call center if you would need that, notification, credit and identity theft, crisis communications, and then forensic accounting and claims preparation. So I won't go through this because we are at time, but this is additional information that I just wanted to provide in the event as you download this the presentation at a later time. These are just some quick tips and things that you want to be aware of. Excellent. I don't know if we have a lot of time for questions. Allison, I will let you moderate that however you would like.
All right, I do think we're a little bit over time. Thank you for this, Daniel. This is absolutely fabulous. Sorry, the presentation, Daniel, we are going to be able to make that available to.
Yes, I anticipate that we will, either in its current form or with just some very minor modifications. Yeah.
Okay, great, because a lot of that information is fantastic, but for folks like myself who are visual learners, I think it'll be helpful to go back and actually have them in front of them. But Daniel, thank you so much, both to you and your colleague, Andy. I know he had to leave because it's late in London, but thank you so much for this. This is obviously a huge topic for our members and one of increased importance. I would love to have you guys back at some point to have a lengthier conversation about how some of the privacy laws we're seeing in the US are going to impact some of this market.
Yeah.
But,
yeah, just a quick note on that. We're seeing a merging of privacy and security, and it's obviously they're related, but yeah, there is significant overlap.
Absolutely. Daniel, thank you so much. Barry, thank you so much. Molly, did you have anything to close with?
No, just thanks everyone. And we look forward to seeing you at a future webinar.
Thank you.
Thank you all so much for your time. I really appreciate it.